Assalamu alaikum class. In this lecture, we will discuss about stockholders' equity with a net loss. Means in any reporting period, if the company shows net loss, then how we will adjust it with the stockholders' equity, or what is the impact of net loss on retained earnings. So let's begin. We have problem 11.2a from the book Financial and Managerial Accounting, written by William Zaka Bettner. The company was organized in 2006 with the authorization to issue 20,000 shares of $100 par value of preferred stock and 1 million shares of $1 par value of common stock. So these are the authorized share capital. All of the preferred stock were issued. So there were 20,000 authorized preferred stocks, so all were issued, and 300,000 shares of common stock were sold for $20 per share. So the par value of common stock is $100. Sold for $20 means 19 is the per share paid in capital, or you can say it is the premium. The preferred stock pays a 10% cumulative dividend. So cumulative dividends, it is the mandatory dividend. The company will have to pay dividends. Um, so during the first 5 years of operation, that is from 2006 to 2010, the company earned total means this $4.460 million is the total income of first 5 years, and then paid dividend of $1 per share each year on the common stock. So this is the common stock dividend, and stock dividend is because this is the cumulative preferred stock, and we have discussed in the previous lecture that the company will have to pay these dividends first before paying any dividend on the common stock. So this is mandatory. And then, however, in 2011, the corporation reported a net loss. So company has net loss also, so paid no dividends. So in first 5 years of operation, company earned profit, whereas in last year, that is 2011, the company reported a net loss. Prepare the stockholder equity section in the balance sheet, which includes a schedule showing your computation related to retained earnings. So we will have to calculate retained earnings separately. So let's get started. We are going to prepare partial balance sheet. So for balance sheet, the main headings are, you will have to write down the name of the company, which is Waller's Publications. Then publications, then name of the financial statement, partial balance sheet, then date, we are going to report this on December 31st. So December 31st, 2011, and stockholder equity. So in stockholder equity, first we have common stock. So common stock, total 300,000 shares were issued. So 300,000 shares, and the par value is at the rate $1. So $1 is the par value. So now we are going to calculate this amount. So we have a dollar and this one. So 300 multiplied by 1. So this is your common stock. Then we have 10%. This is 10% cumulative preferred stock, which is 20,000. All authorized shares were issued. So there is no difference between authorized and issued share. So 20,000 shares at the rate issued at par. So par value was $100. So $100, 100. So 20,000 multiply by 100. Okay, this is multiplication. And then we have additional paid in capital. Additional paid in capital, which is actually the premium on your common stock. So common shares were 300,000 shares at the rate, the premium, how calculate premium. The par value is $1 and it is issued at $20. So 19 is the difference. So at the rate dollar 19. So 19 is the premium or additional paid in capital. So 300,000 multiplied by 19. So this is your um, additional paid in capital. So the total paid in capital would be, by adding all these three, we get 8 million. So this 8 million represent total paid in capital, and we will add retained earnings to get the total stockholder equity. So retain earning, for retain earning, separate calculation is required, include a supporting schedule. So separate schedule or calculation is required. So calculation of retained earnings. So first 5 years retain earning or net income for the first 5 years, that is from 2006 to 2010, is so total, it is reported here 4.460. So 4.460 is here. Then we will deduct, first of all, preference dividend, preferred dividends, which is 10%. So total preferred stock is $2 million. So 2 million multiply by how much dividend? It is 10%. 10%, and it is for 5 years. So multiply by 5 years. So here we are going to calculate it, 2 million multiply by 10% multiply by 5 years. So this is the dividend on preferred stock, and then we also deduct dividends, common dividend, which is again we have 30,000, 300,000 shares were issued. So, and the amount of dividend is, the company announced $1 per share each year. So 300,000 shares, and the rate of dividend is $1, and this is for 5 years. So we have one minus sign because we are going to deduct it. Okay, and here also we have a minus sign because we are going to deduct it. We have 300 thousand shares multiply by $1 because $1 is the rate of dividend per share, and then multiply for 5 years. So this is our calculation. 1.5 million is the dividend. So we have retained earnings as on December 31st, 2010. 2010, why? Because the profit is this profit is for first 5 years. So this is for 2010. So how much retained earning is there? $1.96 million. So this is the retained earning, and then we will deduct net loss. Less we have net loss for the year 2011. So for the year 2011, you can say it is given here, this one, $1,750,000. So we will deduct it, $1,750,000. So our total retained earnings as on here we have, you can see total retained earnings. There's no need, in fact, there's no need to write down the word total. So retained earnings as on December 31st, 2011 would be 210,000. So now we are going to present this retained earning in the equity section. Here we have this one. So retained earning amount is total we have just calculated. You can see 210. So $210,000. Now when we add or sum these two, that is total paid in capital as well as retained earnings, total retained earning. So when we add these two, the amount is 8 million, or you can say $8,210,000. So this is your total stockholders equity. So this was the requirement. In this problem, the we had net loss for the year 2011. So we deduct it from the previous retained earnings. So this is the treatment of net loss. Requirement B, draft a note to accompanying the company the financial statement disclosing any dividend in arrears at the end of the 2011. So we have already discussed that it is mandatory to pay, or it is because the dividend is cumulative. So we'll have to accumulate the dividend. So that's why the dividends in on the preferred stock is in arrears. The In 2011, as the company shows net loss, so company has not paid any dividends on cumulative as well as common stock. So as far as the disclosure is concerned in requirement B, there's need to um, prepare a note in the financial statement that is as of December 31st, 2011. Dividends on the 10% cumulative preferred stock were in arrears to the extent of $10 per share. There's need to represent the amount of dividends per share, so $10 per share, amounting in total $200,000, means total dividend is also required to represent or in disclosure. So you can say that what is the amount. As far as amount is concerned, we will present in note to the financial statement that total here 10% means you can take 10% of 2 million. So this is the amount of dividend. How you are going to calculate 2 million into 10%. So 200,000 is the total amount of dividends. So this amount should be reported in the financial statement, in the notes to the financial statement as a disclosure requirement. Do the dividend in arrear appears as a liability of the corporation at the end of the 2011? No. Why? Because dividends do not represent in a liability of a corporation until they are declared by the board of directors. So there's no as such declaration is mentioned in the whole problem. So the answer of part C would be no. um, it will not it will not be appeared in the liability section in the balance sheet. Just there's a need to represent it in the notes to the accounts or notes to the financial statements as it is mentioned in requirement B. So that's it from this problem. Take care, class.